Hello, class. If you're here with me today, you survived Unit 1. Good job. We're moving on to Unit 2 now. We're going to kind of change a little bit on what we're doing when we get into this unit. Okay, so in Unit 1, we kind of introduced some basic managerial cost concept terms. We're still going to use those terms. We're just going to add a little bit onto it, but we're not going to be worried so much about assigning costs to products anymore. Now we're going to be looking at different costs and different information that we need in order to make decisions. Okay, decision making, that can be considered the main theme of unit number 2. We're going to start off in chapter 7. We're going to do cost, volume, profit analysis. Okay, this is going to kind of help us get into looking at operations and making basic decisions that have to do with cost, how we set our costs, the volume, the number of units we sell, and how that relates to profit. So we can find things like our break-even point, or margin of safety, operating leverage, how many units we need to sell in order to reach a target income, stuff like that. And then chapter 8, we're going to look at short-term decisions, operational decisions, things that affect income. And then we're going to skip up to chapter 12, where we're going to talk about capital decisions or investment decisions for long-term. All right. So this first chapter here is just kind of laying the groundwork for the short-term decision-making, because if you understand how these cost flows work, when it gets into the short-term decision-making, a lot of times you can skip multiple steps in there because you'll recognize maybe the contribution margin right away. So you don't have to go through the process of finding the contribution margin. It just might start popping out in your head. But anyway, let me get my slides going here, get my screen shared, get right into it. These, man. As you can see, if you hopefully you have your outline out with you and handy. The outline is only 1 page, so it doesn't look that bad. But man, this slideshow, 73 slides. Okay, so sometimes it takes 3 or 4 slides for them to explain one little minor point here. So some of these I might skip through pretty quickly. I'm going to try to go through them all here at one time, but we're going to talk about cost, volume, profit analysis. Again, we're going to analyze cost, sales volume, and sales price to discover how each is going to affect our profit. Okay. Let's still, help us reach important benchmarks. Break even point, that is one major thing that we need to know. If we're going to run a business, the break even point is where total revenues equal total cost, i.e. we break even. Okay, we have 0 profit, we have 0 loss. Okay, that's a very good thing to know when you're getting ready to open a business or while you're running a business. How many sales do we need to make sure we cover at least all of our costs and we break even? Anything over that is a profit. Okay, it can be many other things we're going to do with it. Okay. In normal operations, okay, total revenue minus total expenses gets us our operating income. Okay, that's great information for us, but we need to, for CVP analysis, we need to organize our costs a little bit differently. Okay, instead of just having total revenues minus total cost to get our operating incomes, to understand how changes in costs can affect our profit, it's better for us to know what our variable costs are and what our fixed costs are. We talked about this a little bit in chapter 3. So remember, variable costs. Those are costs that change with the level of production. This is on a total level. Okay, direct materials, direct labor. Okay, those were always variable costs because the more we produce, the more materials we're going to use, the more labor we're going to use. There is some variable overhead, such as maybe your electricity. Depreciation could even be a variable overhead, no depreciation. Scratch that. But then variable selling expenses, maybe such as sales commission. Then we have fixed costs. So our fixed overhead and our fixed selling and administrative. Remember, those are costs that are constant. Total of what we're going to pay no matter how much we produce. And so when we're doing this cost, volume, profit, the CVP analysis, We really need to understand the difference between what a variable cost is and what a fixed cost is, because we're gonna make a totally new income statement called the contribution margin income statement, which looks like this. We have our sales minus our total variable cost gets us to our contribution margin. Okay, that is a new term. Important to know what contribution margin is. Remember, it is your total sales minus your total variable cost gets you your total contribution margin. Then we subtract out our fixed cost to get us our operating income. Okay. Contribution margin, saying it again here, the difference between sales and variable expenses. Okay, get used to seeing this contribution margin income statement. You're gonna have to make some on your homework, okay? So how to prepare one here? We plan to sell 1,000 mowers at 400 each in the coming year, and here's our product costs. We have direct materials, direct labor, variable factory overhead, total fixed. Then we have a variable selling and a fixed selling. So we're gonna do a contribution margin income statement here. What would our revenue be? Well, total variable expenses for the year. This is the first thing they want to calculate, okay? So if we're looking at our variable expenses here, we have 180, 100, 25, and 20. So 900 plus 20, 110, $135 per mower in variable cost. Okay, we have to multiply it out by 1,000 to get our total variable cost. And then we have total fixed cost of 45,000. So there we had that 325 variable expense per unit, total fixed expense 45,000. If we were going to make our contribution margin income statement, 400 times 1,000 mower sales, $400,000. Our variable expenses were 325. Get us a contribution margin of $75,000. And what you can see is the contribution margin. At first, it's going to cover your fixed expenses, and then the remaining becomes operating income. Okay, so that's why a contribution margin is a great number to know. Okay. We can also figure our contribution margin on a per unit level. Okay. If we, instead of just doing total sales minus total variable cost, if we break everything down to a per unit level, we can say our selling price minus our unit price. That gets us our contribution margin per unit. Okay. Because now we're going to be talking about break-even points. Break-even point, this is the formula that you're going to need to know. Total fixed cost divided by the unit contribution margin. Now that's what I was just talking about there. When you take the selling price minus the variable cost per unit, you get a unit contribution margin. You can also take the total contribution margin divided by the number of units sold, if that's the information you have. That also gets you your contribution margin per unit. But that is what you need in order to calculate your break-even points in units. You take your total fixed cost divided by your unit contribution margin, and that tells me how many units you need to sell to have zero profit. So remember that the mowers sell for $400 each, and the variable cost per mower is $325, and our total fixed costs were $45,000. That's the same. Calculators. We're gonna worry about number 2 here. Don't worry about doing it this operating income method here. Okay. Break-even point number of mowers, our total fixed cost divided by unit contribution margin. Our fixed cost for 45. Our unit contribution is 75, the 400 selling price minus the 325 variable cost per unit equals 600. Okay, so that means we need to sell 600 mowers in order to break even. This is proving it here. 600 mowers at 400, 240. Variable expenses 195 gets us a contribution margin of 45,000. That just covers all of our fixed expenses, making our income zero or we broke even. That just kind of proves it that formula works. Okay, if you want to find it in sales dollars, I find the easiest point here is just to do find your units, and then multiply it by the selling price. So here we need to know the break-even sales in dollars. We know we needed 600 units. They sell for $400 each, or $240,000. But there is also another way to go about getting that. That is with your contribution margin percent, or your contribution margin ratio. Okay, there's a variable cost ratio and a contribution margin ratio. Okay, these are all related to the selling price. When we sell the price, it's going to be either variable cost or it's going to be contribution margin. It is going to take up 100% of the price. So here we have where we sold something for $10. The variable cost per unit was 6, which made our contribution margin per unit 4. Okay, so if we take our 6, our variable cost per unit divided by 10, we have 60%. That is our variable cost percent. On the other hand, our contribution margin ratio, or contribution margin percent, is the 4 divided by 10, the contribution margin divided by the price, or the 40%. The variable cost ratio and the contribution margin ratio, they are always going to equal 100% when you add them together. Okay, because like I said, the selling price is either going to be variable cost or contribution margin. So if we wanted to calculate how many dollars we need to sell, remember we did it by finding units. Remember, it was fixed cost divided by the break-even point, or break-even point, fixed cost divided by the contribution margin per unit. Okay, well, and then we can multiply out those units by the selling price to get our dollars, or we can take our fixed cost. Well, sorry, this example is showing something else. But we could take our fixed cost and we could divide it by the contribution margin percent, and we can get the same dollar amount. So first we need to calculate the contribution margin percent. The variable cost was 325 divided by 400 is 81.25. The contribution margin per unit is 75 divided by 400. And yes, this is a typo. I did not make these slides. It came like this. This should be 1875. 18.75% goes to contribution margin, while 81.25% goes to variable cost. So just think about this logically. What that's saying is every time we make a sale, 81% of that revenue is just covering cost, the variable cost, okay? And basically 18% is profit as long as our fixed costs are covered. Here's our contribution margin based on these numbers. 400,000. So what are we saying? That we sold them all? Yep, and that's just kind of proving those numbers out. And this is what I was getting to here, break even in sales dollars. If you took your total fixed cost and you divide it by your contribution margin ratio, that is going to give you the same dollar amounts. Okay, so here we have the same $400 mowers with a variable cost of 325, fixed expenses of 45,000. Contribution margin per unit was 75. Our ratio here, 18.75. It's got it right this time. So we take our total fixed cost and we divide it by that ratio, that 18.75%, and we get $240,000. Okay, that was just a long roundabout way of showing you that no matter which way you do these problems, you can come up with your break-even sales dollars to be 240,000. Think back, that's what we got for units, the 6,000 units multiplied by the $400 selling price. So you don't really need to remember both of these because, I mean, sometimes you might if not all the information is given, but most of the time you can find your units and go back and calculate your dollars from that. But maybe you're just given a percent, so you have to do it in dollars amounts. If we are going to do a problem, if it asks you a question about reaching a target income, okay? I'm not going to run through all these examples. These are going to be a bunch of slides that I'm going to skip through here because it is the exact same formulas with the exact same reasoning behind it. The only difference is this top part here. You have your total fixed cost, you add what you want for your income into it. And you divide by your contribution margin per unit to find units, and divide by your contribution margin percent or ratio to find your dollars. And if you want to take the time to look through these examples here, you'll see it works out for you. So why is this information important? So assuming that our fixed costs don't change, and we are making a profit, we're making a $10,000 profit. Well, if we say sales are going, we expect sales to increase by $200,000. What is that going to do to our net income? Well, it's going to go up by $200,000 multiplied by the contribution margin percentage, because our fixed costs are already covered. Okay, so it allows you to work some numbers in your head a lot easier when you know how much of your selling price is contributing to your profit or covering your fixed costs and then your profit, and how much of your selling price is your variable costs of production. Okay, so it's all well and good, but you know, a lot of companies, they don't just sell one product. Okay, they're trying to break even on multiple products. Okay, so there is a way to do a multi-product analysis. Okay, that's what we're gonna do here. And I understand that sometimes when we have multiple products being produced, sometimes there are direct fixed expenses. That means that we can directly trace those fixed expenses to that product. Okay, and then there's some common fixed expenses, whereas we can't trace it to that product. Okay, it's more common to the whole plant. It's kind of the same as that direct and indirect cost. Can we directly trace it to that cost object? In this case, we're talking about a production segment. If we can, it's direct. If we cannot, it's common. Okay, so when we want to find out our break-even packages for a product, we're worried about those direct fixed costs. So we are going to do our total fixed cost divided by this, what they call a package contribution margin. Okay. I called it on your notebook. This is where we're talking about multiple break-even point. Okay, I call it a basket of products. Okay, they're calling it a package. Okay, as you can see, it's kind of the same type of formula. Our fixed costs are still the numerator in this equation. We're just looking at a different denominator here. So what I mean, so on your handout, it says first find your sales mix. Okay. The sales mix and everything we're going to be doing is going to be given to us here. So here in this question here, it says Whittier's expected sales mix is 3 mulching mowers to 2 riding mowers. Okay, so that's the first thing we always need to do. How do our sales compare? We have 2 products, we have product A and product B. Well, we sell 7 product A for every 3 of product B. That's a sales mix, right? Here, we sell 3 mulching mowers for every 2 riding mowers we sell. Another way to express this is we can say we sell 60% mulching mowers and we sell 40% riding mowers. That is a 3-to-2 sales mix. The first example I gave you where it was 7-to-3, that's a 70 to 30% sales mix. Okay, so that is the first thing we need to do. Step 2, once we have our sales mix, is we create a basket of products. Okay, what I mean by that is we have a sales mix where we're going to assume that we sell one big basket that includes our whole sales mix. Okay, so in this example, we're going to create a basket. Our basket would include 3 mulching mowers and 2 riding mowers. Okay, and we're going to consider that our basket. And that is going to be one cell. Okay, that is making our sales mix into one cell. And that's what we're showing here. See, our sales mix is 3-to-2. So our basket is 3 mulching, 2 riding. The next is calculate our contribution margin of the basket. Okay, well, here's the information for our mulching mowers. We are having a 75 unit contribution margin in our sales mix in our basket. We sold 3 of them. So in the basket, the contribution margin for the mulching is 3 times 75 or 225. For the riding mowers, we get a $200 contribution margin, and there's two of those in there. So a $400 package contribution margin. When we add those up, we see that our basket has a contribution margin of $625. Okay, so that is step 3. Next, we need to determine how many baskets do we need to sell to break even. Well, our fixed costs are $96,250 divided by the 625, that's the contribution margin per basket, gives us 154 packages or baskets. I'm just gonna stick with baskets. So we have 154 baskets that we are selling here. A product to break even. Well, what is in each basket? Well, there is 3 mulching mowers and 2 riding mowers. So to find out the number of exact units of each product, we take our number of baskets that we sold and multiply it by how many each are in there. Okay, and that gets us our break-even point with multiple products. And here's some information just working it out for you, proving that this information is true. Here it's showing we can do it with the percent also. Okay. So if we need to find a dollar amount, we can take our fixed cost divided by our contribution margin ratio, because that's all enough information we're giving, and we're not giving anything on a per unit level for either product, so we can't create a basket. Okay, we just know what our sales and what our variable costs were. So we get a contribution margin ratio of 22%. So we take our fixed cost divided by that 22%. And get 431. All right, risk and uncertainty. I want you guys to read through this on your own. Margin of safety, though, is something you're going to have to calculate in your homework. What your margin of safety is basically how much above the break-even point are we? How much safety do we have before we start losing money? Okay, so if we're talking about in units, our margin of safety is our total number of sales units minus our break-even point in units. So if we sold 500 units and we needed to sell 200 to break even, man, these slides are horrible. There's so many typos on them. There is actually 300 there, not 30. 300 is our margin of safety. Okay, we can lose 300 units in sales before we start losing money. Same way we can do it in total. Okay, margin of safety, $500,000 in sales, $200,000 was our break even in sales. So we have a $300,000 margin of safety in dollars. If you take your margin of safety divided by your total sales, you can even do it on this one. You can take the 300 divided by your selling price, or the 300 units divided by the 500 units. Either way, you're going to get a margin of safety of 60%. Okay, meaning sales can drop off a lot here before we start losing money. Finally, we have the degree of operating leverage. We calculate that by taking the total contribution margin divided by operating income. And here is total, not at a unit level. And what this is showing us, what this does show us, is that companies that are structured with a higher fixed costs, okay, they have a higher operating leverage. A higher operating leverage means when your percent of sales increase, your percent of operating income increases greater, okay, than someone with lower fixed costs. It does not mean that the total dollar amount is bigger. It just means that maybe if you have a higher operating leverage, if we increase sales by 10%, okay, our operating income may increase by 30%. Whereas if we have a low operating leverage, if we increase sales by 10%, we might only increase profits by 15%. Okay. Just based on your company's financial structure, on that fixed cost, variable cost type of thing. And like I said, it plays no role in overall, it's all on a percentage level. Right, so here are some examples. Margin of safety, 100, minus our 600, break even 400. Margin of safety and sales revenue. Well, you can just take that 400. We could multiply it by the $400 too, huh? By the selling price, $160,000 margin of safety. And then operating leverage. So here we have to find our total contribution margin, which was 75 was our contribution margin per unit, multiplied by 1,000 units sold. So that's a total of $75,000 divided by the operating income, which was given here. $30,000 gets us an operating leverage of 2.5. Okay. The higher the operating leverage, the higher percent profit is going to increase. Okay. Your percent change in operating income equals your degree of leverage multiplied by your percent change in sales. Okay. So if we expected operating income to increase by $30,000 and our operating leverage okay, here's what it says. We expected sales to increase by 20%. Okay. Our degree of operating leverage was 2.5 from our previous example. So if our sales went up 20% and our degree of operating leverage is 2.5, that means our income is going to go up by 50%, 2.5 times the 20. And then they're proving it here. Expected operating income would equal $45,000. Okay. And I know in the end of there got a little drawn out, a little boring with some of those last final concepts. You need to know how to calculate them. The main thing I want you to pull out of this: contribution margin percent, contribution margin per unit, how to find the break-even point. Okay, and kind of remembering how those costs behave. Remember those contribution margin is going to be so helpful moving on to chapter 8 on that next one. I have one handout for you in chapter 7. I'll be coming to you next with that video. As always, if you have any questions, do not hesitate to reach out to me. I'm here for you. Best of luck. I'll talk to you again soon.